Good afternoon, everyone. Welcome to this session on Indian capital market and its ecosystem. So, obviously, the name will tell you a lot of things. I'm sure you all will already be knowing a lot of things about it, but we'll try. We'll try with some basics and then gradually move into details and technicals and things like that. Yeah. So we have two keywords here in our topic, which are these: capital market, obviously, and the ecosystem. Yeah. So, what is capital market? Let's keep it interactive, and I'm not asking any technicals, all common sense kind of question answers we will have. So, because otherwise you have come after lunch, you'll fall asleep if we don't talk.
Where we keep on buying equities, derivatives, and we invest in different organizations.
Okay, so you keep on buying. From whom?
From the seller.
So somebody has to be there as a seller also, yeah?
Buyer and seller.
Yeah. Okay.
And they
Okay.
generally sell on their profit or depending upon their own.
Sure. So is that your luck or is that your effort? If you're making profit or loss?
It's you can say both things. Sometimes
Acha.
you purchase a share and it goes slightly up and you realize it down. But sometimes it goes vice versa as well. But many of them go with technical analysis, fundamental analysis, go with the conceptual and that.
Okay. So not necessarily in today's session, but I am sure over the period of next few days and on an ongoing basis in your assignment, you will learn more of these things in more detail. So he's saying capital market is where we buy, and obviously if you are buying, there has to be a seller. Anything else? Anybody wants to add, change, delete? Yeah, nothing else, nothing more. So it's like anything else. We have a fruit market wherein fruit gets bought and sold. We have a vegetable market. We have grains market. So like that, we have capital market. As I said, we'll start with very basic common sense kind of things and then gradually move into technical. So capital market is basically a place where capital gets traded. Yeah, trading means there has to be a buyer and a seller. So it's only that the difference is, unlike other markets, it's capital, it's hard money, which is of course very important in life. So that is what a capital market is. So if we were to define or just put it in refined language, we can say that capital market is a place where capital is exchanged, yeah, traded between obviously capital suppliers and those who are in need of capital. Yeah. So who are the people? Who are these people or entities who are in need of capital? Companies, yes. For what? For growth, expansion. And who else? Sorry? Government, okay. Yes, government also needs capital. And say loudly. Financial institutions. Something more these days very popular. Say loudly. AMCs, we'll come to that. They are more of intermediaries. Yeah, somebody here was saying something. Some female voice I heard. Family office will come where? Out in these two places. Right now we are talking of entity who need money. Does family office need money? They actually have a surplus. So they'll come in the first capital supply. Who are the capital suppliers? Yeah, investors. And who are all these investors? FIIs. But more stronger than FIIs are who today in Indian market? Yeah, DIIs, other individuals, Indian retail investor. Yeah. So all these are investors. Even the companies that we are talking of that they need capital, there are a lot of companies who have surplus capital, surplus money, because they have reached a certain level in their business cycle wherein their business is profit making, is throwing a lot of money, and probably they don't have enough investment opportunity, and as a result they have a lot of surplus cash which they are in turn looking to invest. So they will also, so companies can be at both ends, capital suppliers also and capital requirers also. So we have largely covered, but in terms of capital users or people who need capital, just give me one more entity which is very popular these days. Startup guys. Yeah. So they have a lot of ideas, but unfortunately quite a lot of them, most of them don't have capital. So that is they are the ones also need capital. Yeah, somebody was saying something here. Sorry. Yeah, NBFCs again is an intermediary. Yeah, we'll talk about that, the differences in all these also. So that's what capital market is. That, put it differently, it's a place where various entities trade different financial instruments. Yeah. Also at this point of time, so why do we do all this? What is the need of capital market? I mean, we saw that it's a place where money gets traded or exchanged, and whenever you trade or exchange, you obviously do it for some benefit in mind. Yeah. But why create all this infrastructure of having a capital market and so many things and all that?
Because it's not possible that we, first of all, the marketplace is bigger than the going to the individual. You can cater 10 to 15 people if you go for private equity, but where capital market, you have lot of investors who can buy your shares in the market.
Yeah, so you have gone to saying that why private equity or why? Okay, obviously my question may not be as clear, so let me say what I was trying to say. That basically for any society, or in our case we can say any country or any economy, to grow, it's very important that the limited capital that is available in that society is put to best use. And to put to best use is this whole capital market system is created. That, as we said, there are savers of capital, who people or entities or companies who have invest surplus, they are looking to invest because they want money, isn't it? They want return. And at the same time, there are people who need money. So unless there is a mechanism, a place which is created to bring them together, savers will keep sitting with savings and will not be able to invest and earn return, and people who need money won't know where to go to get money. So that's why this whole capital market is created. Basically, it is leading to the increased productivity in any economy, increased usage of the capital, and capital will always be limited, howsoever surplus you might have. As you keep growing, you meaning it could be anybody, it could be individual, it could be family unit, it could be smaller companies, it could be country as a whole. Your capital will always be a scarce resource, a limited resource which you would want to put it to optimum utilization. And that's where capital market comes in. Because of the various entities that are there in capital market, the whole effort is to put the capital to optimum use, to have as high efficiency of capital as possible. And that's why we have this capital market and the whole paraphernalia around it. Explaining the same thing more. So capital markets are financial markets that bring buyers and sellers together. We already saw that. Yeah. They help people with ideas become entrepreneurs. Important point. Yeah. So if you have best of the ideas, but if you don't have money, then you won't be able to execute that idea. You won't be able to put it in practice. So they help people with ideas become entrepreneurs and help small businesses grow into big companies, obviously. So an entrepreneur, when he has started, he has reached up to a small business level. Now he wants to grow. His idea is successful. There are a lot of ideas which fail also over a period of time. So how does that company become bigger? Is that somebody will need to give that company more of capital, and then they can grow bigger and bigger. Yeah. What is ecosystem? Very common sense. Why are you all thinking so much? Okay, let's address it differently. Uh, what are the few things that we Indians love most? Say loudly. Cricket. Did you say that? Yeah, don't worry. And what else? Yeah. Some savings, yes, of course, yes. And say loudly. Food, yes, okay. Okay, so let's restrict it that when it comes to Indians, you are very right. One, cricket is our first love. Gold somewhere is our second love. Yeah. And then many more. So let's stay with cricket for the time being. And let's try and do an exercise. So for cricket, you obviously have two teams is what you need. Team A and team B. Now you want them to play a match or a game of cricket. What do you need? What will you need? Say loudly. Ground. Did somebody say that? Yeah. Give me a minute. Okay, so you will need ground. What else? Pitch is a part of that. Okay, you ground including pitch, you can say.
Players,
Some
umpires.
umpire. Okay, if two teams are playing, then you obviously need somebody. There'll be a lot of disputes or difference of opinion. Umpire. Okay, then players, yes, which is included in that, but of course we can take separately. Did somebody say rules? Yeah, okay. Then what else? Sorry, somebody saying something here? Say loudly. Cricket kit. Yes, of course. Technological infrastructure. Okay, can you put it in cricket context? Can I say scoring? Something like that?
But technology involves cameras, digital.
Okay. So let's put technology, including hardware and all that.
I'm not promising
Yeah.
anything would be
Then, then when sorry, you're saying something. When this whole thing gets created, what else start to happen? Yeah, important point. Media, isn't it? So there are a lot of journalists who start writing. Yeah, and so on. So there'll be a lot of, so media is one play. There are others who become, if we can say, critique. They go really into detail into analyzing players, their performances, their actions, and things like that. So critique. Then when all this happens, what happens to do these rules and all? What do you need? Somebody who has to maintain the rules. Yeah. So you, sorry. Yeah, ICC. Okay, whatever you want to call it. So and many more things. I mean, you will have a lot of things here. When you have umpire, you will obviously have a third umpire, you know, and then you will have a referee also, and then you will have a TV umpire. So and lot more things. So what is all this around cricket? Can we call it ecosystem? Isn't it? Yeah. So now let's extend this analogy to capital market, which is our topic for today. Can you tell me who all in our capital market are all these people? Are, can we say players? Yeah.
rules can be SEBI, as RBI, and other institutions.
Okay. What is ground? Exchanges. Yeah. So for the lack of any other color, I am writing with red, but red obviously kind of indicates not so positive, which is not the intention here. Exchanges. Then who is the umpire? SEBI. Yeah. Okay, whomever you want. So who will be the ICC if SEBI is umpire then? Okay, so just a clarification at this point of time before we go. There is a very broad distribution of overseeing regulatory, what words do I use? I'm not getting. SEBI largely look at equity related matters and RBI looks at debt related matters very broadly. There are a lot of overlaps, lot of interaction that they have to do and things like that. But having said that, so okay, wherever you can either put SEBI here or you can put SEBI/RBI here. Yeah. So who is a scorer or scoring? Who does in capital market? So there are, we will talk about those. There are some custodians, kind of, not necessarily. Then there are depositories. Their functions are overlapping and but something related to that. Yeah. And kit. Okay. So no specific. Yeah. Okay. So kit, you can say demat account. Okay. Who are the media when it comes to capital market?
News channels.
Yeah, all these news channels and newspapers. Yeah. Yeah, CNBC or whoever. And I specifically mentioned critique. What do we mean when we say here in capital market?
Fund manager.
Yeah, research analysts, fund managers, portfolio managers, they are the one who kind of look at all these things in detail. And like that. So we have a lot more entities in capital market ecosystem. But I hope this analogy and this comparison has given you some feel that what is capital market, what is the ecosystem around it, and it gets developed. Nothing of that, neither in cricket nor in capital market. When you started day one, that everything was there. You feel the need over a period of time that this particular thing is not happening, or this area is getting neglected, or people are taking wrong advantage of something because the rules are not in place. So then you create mechanisms. So SEBI itself came in existence, I think its act is 1992, and by the time they came in actual practice, it was 93, 94 or something like that. Before that, there used to be something called capital of controller issues. So that was a different regime, different rule. Yeah. So it is an evolution. So SEBI has, came in picture. Then we got exchanges. Earlier, only BSE was there, and then there were regional stock exchanges in Kanpur, in Chennai, in Jaipur, in Baroda. You have a question? So like that. But when electronic trading came in, the need for regional stock exchanges kind of got over, because you had an electronic trading. You could have traded from anywhere in India and abroad also. So ecosystem is also evolution. You don't get it on day one, and it's a continuous process of upgradation. Can we say that today we have reached the best possible ecosystem? No. Yeah. Things keep evolving. The whole area of startup capital raising, the new generation entrepreneurs coming in, and all that is evolving. So that's something that is continuously being worked upon by regulators, by government, by the whole mechanism. So that's what an ecosystem is. So we'll keep talking about these things more. Let's move on. So system or environment around anything is basically the ecosystem of that particular thing. What is capital market ecosystem? We already saw, but let's kind of put it more formally. So I have put it in the word saying that capital market ecosystem is 3 I's. Which are these I's?
Investors.
Okay. Institutions, investors, you said, and issuers. Okay. Intermediaries. Yeah. So largely you have covered all these. So there are investors, as we saw in the definition in the beginning, people who have surplus, who are sellers of capital, if we use that word. They want to give their capital away in exchange for getting something in return. What will be that something in return?
Shares.
Yeah, so shares is a form. Basically, you want return. So if it's a debt securities or debt investment, you want interest, and of course return of principal. And if it's an equity, then you want share in the profit, which means that, okay, dividend will be a very small part of it, but over a period of time, the value of their share should go up so that they make handsome return. And the return should be higher in which of these two?
Equity.
Why?
Because the risk is more in equity.
Yeah. Because in equity, you are taking risk. In how are you taking risk? Anybody here? Volatile. And why, when we compare it to debt, why the debt or the fixed income is not volatile?
The impact that gives to the investors is slightly higher in terms of equity rather than
Yeah, okay. So by basic nature of the product, when you are investing in debt or in fixed income, you are saying very clear that I am giving you 100 rupees. You are telling me you will give me 8% return at the end of 1 year. If that is a term decided, you will give me 108. In between ups and downs, whatever happens, neither of the parties concerned. Of course, there are always chances that the user, buyer, whom we will say, may default. So that risk is always there. Neither your principal nor your interest can come back. There's another possibility. He'll say that, okay, my plan didn't go as I had planned, so I made lesser money. So I am giving you back your principal of 100, and I am able to give you only 4. I can't help it. So of course you have mechanisms such as legal mechanism and all those things to address that. But so as against that, equity is volatile. You have given 100 rupees as one equity share. It may fall to 40. There's nothing issuer will be able to help you. he will try to run his company to the best of his capability. But if that doesn't happen, if share price comes down, it can come down for multiple reasons. I mean, obviously, the company's performance is the main reason, but overall economy doesn't do well. Sentiments are not good. Money is not flowing into any economy. Multiple reasons. Yeah. So equity is a risky asset class. So coming back, 3 I's: investors, sellers of capital, and then ultimately there has to be a buyer of capital, issuers. So that's the second I. And to make these 2 I's meet is what we have: intermediary. Yeah. And a series of intermediaries, various multiple entities. Some of them we saw there, more we will saw as we go along. Okay, before we move into more details in intermediaries and others, what are the various types of capital market? We have already talked about some. I'm sure you would have heard of or been knowing of formally, informally. When we talk of them, you'll recall, but still anything that you can recall. Primary and secondary, okay. Money market, okay, yes.
Market organized
Well, let others also speak. Yeah, somebody was saying something. Kind of services included in capital market. I mean, that will fall into the intermediaries, but right now we are talking of capital market. Yeah, did somebody say debt market here? Yeah. Okay, what else? MCX is a cricket ground. I mean, it's a ground. It's a platform. It's an enable. It's not type of. Okay, you can say type of exchanges or which all exchanges. But right now we are not talking about that. We are basically saying what are the various within capital market various segments. Commodity market, important point. And now when you have said commodity, you can think of something more also. Currency market. Yeah. Yeah. Swaps, okay, we'll come to that. We'll talk about that. Yeah. So largely these are the capital market. Now you know this, but let me put it in structure. You said so many things. So what is the structure? First, so there are 3 ways you can put segments to the capital market. I'll try to show you all those 3. So one is, as we talked about, either the stock market, equity market, whatever we say. Yeah. Then as the moment we talk of equity, immediate is a bond, fixed income, debt, whatever we call it, a bond market. Somebody had said money market. Money market is part of bond market. Money market is a sub-segment of bond market. Then we already talked about this currency or foreign exchange market, and this also you said commodities market. So this is one classification, and this is based on what? It's based on type of instrument or the underlying asset class. Equity is an asset class, fixed income is an asset class, commodity is an asset class. So that's one way to classify the capital markets. Yeah. What are the other ways to classify, which also you said is cash market? What do we mean by cash market? Okay, only equity. And what exactly you have in mind when you say equity? Okay, it will become clarified when I tell you the second point. Sorry. We'll come to that. Cash market and derivatives market. Yes. So this is the second type of classification. This is based on what? It's either based on time horizon or intent or leverage. What do I mean when I say here? So now let's come to cash market or equity or spot, whatever all words we've used. That cash market means I want this, take money this much for this, give me this, and you take your money and go, nothing doing. Uske baad, whatever happens, whether if it's an equity, if it falls, it's my loss. If it goes up, it's my gain. Yeah, you have a question?
Basically, it might refer to the ownership of the underlying asset, unlike in derivative market.
Yeah, so that's why I said time horizon, intent or leverage. Time horizon, let me just clarify it more. So cash is spot, immediate. I have money, I'm paying you, you give me either a stock or a bond or whatever, or even a currency or commodity. Derivative is you enter into an agreement, so to say. You will have more detailed session where you will learn more, to do the same particular thing at a future date. Yeah. So when you are buying, let's say, future or option, or selling future or option, in India the popular expiry is monthly, which we started with. Now we have weeklies also. Now we have 2 monthly and 3 monthly also. In foreign markets, it's multiple other combinations are available. So if you think market will go up, you buy an option that okay, today is 100, I am buying an option for 120 rupees, it will go up in future and I'll make money. So that's what is a derivative market, and that's why I said it's based on the time horizon or your intention, that what do you want to do, or leverage, when basically you are trading in derivatives, a spot, I mean the swaps that you said or whatever, it's basically you are leveraging, you are investing or utilizing less money but taking higher position. So you are leveraging yourself. So that's the second classification of capital market. Then there is one more. Is somebody had said primary and secondary market. Yeah. So just as I said, we know all of these things, but we should be clear that what are we talking about, in what context are we talking about, what is the basis, and then we can't say that there are two types of capital market, is stock market and primary market. No, primary market applies to stock also and bonds also. Yeah, the same way derivatives applies to stock also, bonds also, currency also, and commodity also. The spot market or the cash market again applies to all these. Same way primary and secondary also applies. What is primary and secondary?
First time issue is primary.
Okay.
When we keep on trading it secondary.
Okay. Anybody else? Anything? So why do we need these primary and secondary? Why do we need primary? Let's go one by one. Let others speak. Yeah, somebody else?
Because the rules are different in primary market, it functions differently. When
Okay.
the stock is not listed,
Okay.
the price of the stock, the demand work differently. On the other hand, secondary is more liquid.
Okay. Okay. So you are saying rules are different, secondary is more liquid. Anybody else? Anything?
Exit doors for PE firms.
Sorry?
Exit doors for PE firms.
Okay, exit door for PE and VC. Yeah. Somebody was saying something.
Normally in the primary market, people want to raise capital for the first time.
Right.
They want to enter into the market.
Yeah.
So that is a route where people can come up and go for an application.
Sure. Yeah. So fair point. All of you said more or less. So that's why we say it's a classification based on origin of asset. So these are not any standard definition that I am giving you, but these are more from the purpose of understanding. What do I mean when I say origin of asset is what you all said, that primary market is the where first time the security is getting originated. Yeah. It can apply to equity, it can apply to bonds. And as we said in the beginning, that this is the whole genesis of the capital market, that primary market is where first time the buyers and sellers of capital are coming together, meeting each other and exchanging their intents. That I have money, I am giving you, I want return. He says, okay, I need money, I have business plan, I will grow and will be able to give a return. So that's where primary market comes in. As I said, origin of the asset, which is the first time. In case of secondary market, there is no origin of the assets. It's the existing assets which are getting traded. Yeah, there is no fresh issue of assets or fresh issue of capital. So from a thinking point of view, that we discussed earlier also, primary market is something which is benefiting the economy. The buyers and sellers are coming together. Money is being put, effort is being put to utilize the money to its optimum efficiency. Of course, there can always be. So basically, you are bringing together people who have surplus money. Otherwise, if they don't know where to invest, they will not get return. And people who need money, if they don't not have any source to get money, they will not know how to grow the business. So that's what primary market is doing. Now, what is secondary market doing? It's not doing any such kind of thing.
Yeah, brings the buyer and the seller on the same.
We have brought them together in primary market. Creates liquidity. Yeah, important. Yeah. So today we know, and whenever the IPO market comes in, any investor doesn't think before applying an IPO, except the point that he does analysis and he wants a return and he'll invest only in the companies which are good. But he doesn't have to think that whether he will have liquidity problem or not. A fully developed secondary market is available globally also and in India also. If secondary market were not there, would you invest in primary market issues? Why not? Sorry?
But for long term, if I have no financial.
I think you should give others a chance to speak. Yeah, somebody saying.
No, it's an opportunity.
no exit opportunity. Yeah. So while you are presumably investing in good company or good assets or good bonds or good equity, but there is no way for you to liquidate that. So that's why secondary market is equally important as primary market. While here the money may not be going directly to the companies, but unless the secondary market, efficient secondary market is not there. And when I say efficient, there are multiple things. One, of course, liquidity. There should be enough volume for you to be able to sell, or if you want to buy, you should be able to buy. There should be as low impact cost as possible. What is impact cost? So it's a difference between the price a buyer is willing to pay and a price a seller is willing to sell. So let's say if a share is getting traded or even a bond also, the price is 120 and 125. Seller says I want 125, buyer says I will buy only in 120. So that 5 rupees is the difference. So if there is a relatively lesser liquidity, the buyer will have to keep paying higher and higher price. Same way, if seller is more in need of money, he will have to bring down his 125 expectation down to 120. So he's losing 5 rupees compared to his expectation. Yeah. So that's where a very efficient secondary market is important and is a need of the any growing economy. Okay. So this is the whole capital market ecosystem, largely relevant to India. Globally also it will be largely similar. So it might look too overbearing to you, this slide. So we'll talk of them one by one, but just to put in perspective that this is what we have here. So earlier, talking of cricket, we were talking of, if we want to call SEBI an umpire, then SAT is a third umpire, Securities Appellate Tribunal. It's equivalent to High Court. If you are not happy with some judgments of SEBI, you can appeal in Securities Appellate Tribunal. Yeah. And there are many more. We have investors, market issuers, intermediaries in between. We'll talk about all these. So before we go into more details, there is something called MII, Market Infrastructure Institution. Any thoughts? Okay, never mind. So we have slowly started to move into technicals higher and higher, which is okay. So I will first tell you what it is, and then I'll give you the reasoning so you'll be able to understand better. Out of so many intermediaries that we saw here, 3 category of intermediaries have been classified or defined as infrastructure institutions, market infrastructure. Which are those 3 categories? Exchanges, yeah, not brokers. Depositories, yes, and third, clearing corporations. Yeah. So these 3 category of intermediaries have been defined as infrastructure intermediaries or infrastructure institutions. And why? Without them, we can't function. So we will probably be able to function without, let's say, for a moment, investment banker. How and why we will have to see. But yes, we may not be able to work without, we may be able to work without registrar and transfer agent. Company itself will do. Earlier, companies only used to do that activity. Only now we have a separate category. But without these 3 institutions, the exchanges, the clearing corporations and depositories, we possibly would not be able to efficiently work in the, it's like today we have 5G. Yeah. So you need those 5G networks. If they were not there, would 5G be able to run? We have best of the cars and utility vehicles and all. Of course, accidents have increased, but at the same time, what would be the use of having best of the Audis and Porsches and all if we didn't have good roads, which we don't have actually. So it's only on the highways and expressways that we have, where also we have limitations of speed. Should it be, should it not be? One can keep arguing, but that's not our topic for today. But if there are not good roads, is it any use having best of the cars? Possibly not. So that's why it's very important that we have best of the infrastructure in place, and these are the 3 categories of institutions which have been put in the infrastructure category. Today, for NSE trades world's highest number of trades. and the whole technology that is behind it is able to handle that kind of volume. So to be the world's largest stock exchange in terms of number of trades, you need some capability, you need some systems, some technology, and reliable. So that's where we have these three categories of institutions. We already saw that what are the various activities and functions that they do, but still we will go through them. Stock exchanges, we already saw, they provide liquidity function, bring buyers and sellers together, and aggregate the demand and supply of the securities. Price discovery function. So we didn't talk about this. That's another important point. Any asset, at what price it has to trade, what price it has to get bought or sold, or the valuation of a company. Again, once you have done that in primary market, yeah, when you bring, especially the valuation or the price discovery refers to equity. In bond, it's not as much. Bond company defines that I want to raise 100 crore or 500 crore or whatever. This will be the rate of interest I will pay. This is the frequency I will pay, whether quarterly, half yearly, annually. And this is the number of years that I will redeem it and give it back, 3 year, 5 year, or broken up between 2-3 options. In case of equity, the question of price discovery, the valuation comes in play. So first of all, when at the time of a primary market going in for an IPO, a company does its valuation. When we say company, of course, it does it in kind of discussion with the investment banker, the lead manager that it appoints, the merchant banker. They help company discover the prices. And of course, they take market feedback also. They will go and meet some larger institutional investors and would kind of formally, informally discuss their business plan, tell them about their business and all, and try to get a sense that at what valuation market will accept that kind of business with a particular set of fundamentals. So that's the first level of price discovery that the company and its investment banker has done when they go to the primary market with its IPO. Once the company gets listed, what happens? What is happening these days? Anybody tracks IPOs, invest in IPO? What is happening these days? Okay, MQR was listed. Yeah. So what happened? 38% premium on the listing. Okay. And which is what is happening to most of the companies. When we say most, obviously, there have to be a certain minimum level of good financials and fundamentals in place. And then comes the valuation or the price discovery that we are talking of. So there is an X price which MQR Pharma came out with an IPO, and then there is an X plus, in this case premium. Is premium guaranteed in all the cases? No. Yeah, there can be discount also, there can be losses also, and there are again multiple examples of that. IPOs which came in the past, in last 1 year, 2 year, 5 year, whatever period. So that's what a price discovery function is, which happens on the stock exchanges. Then hedging function, you will learn more of it in your derivative sessions. But derivatives, when we are talking of, there are multiple objectives. You simply want to invest by using less capital, and that's why I use the word leverage. Or you want to hedge your portfolio. As I said, you will study more in detail. So we'll skip here for now. Efficient capital allocation. What do we mean? So nothing much. It's basically more that as an investor also, if you have invested earlier, you made some money, you might want to take some money off the table, and probably you think that there are some other investment opportunities which in valuation terms, in price discovery function terms, is more attractive. So you reroute your capital to that way and try to take maximum out of your limited capital. As I said, that will be something that will always be a scarce resource that will be there. Regulatory function. So many of the things that all these intermediaries do is assure settlement of trade, assure market integrity. What do we mean when settlement of trade? One minute. There is a
Guarantees if at all if there's a buyer or a seller.
okay.
It guarantees the funds and the securities to the buyer and the seller.
It guarantees the let's say counterparty obligations. If you are selling, it kind of guarantees that you'll get your money. If you are buying, it kind of guarantees that you'll get your securities. What else? Somebody here was saying something. Yeah, so basically that so it's not a stock exchange, it's the clearing corporation which is mainly responsible, and that's why the role of clearing corporation comes in play here. That so let's try to compare it with some deal in person that you do. Let's say you sell a property, you sell your house or a flat or a piece of land. uh, what is a typical process? You try to identify a buyer, either directly or through a real estate broker. These days you have a lot of online facilities also available. Let's assume you found a broker. Then what do you do?
Then he finds a party who is ready to buy a property.
Say loudly.
Then he is the person who will contact different parties.
No, so you are saying either we find a broker or we find a person who is an actual buyer. Now you found a buyer, let's say. Then what will happen?
Then there would be a price negotiation.
There'll be a price negotiation. You will arrive at a price at which if you agree that you will sell and he will buy. Then what happens?
Legal contract.
Legal?
Contract.
Okay. And then?
Then the payment is done and transfer
Okay.
of property.
Okay. And how is the payment done?
Cash, check.
Okay. And what else? All together, broken up, earlier, immediate, later?
It's like 3 months of time. The law
Okay.
legally
Okay.
has.
Fair point. So you 3 months before registry, after registry, or what?
It's like deal is done today, so 3 months after, within 3 months you need to pay the whole amount. If you don't pay whatever the initial amount is, you have paid that is one.
Yeah. And when you say the deal is done, that do you refer to the date registration of property transferred in the name of buyer?
Transfer is done when the whole amount is received.
Okay. Does it happen in all the cases?
No.
Okay. So then what happens in other cases?
If there is a instant cash and then instant registry would be done.
Okay. Can there be any other is there a possibility that buyer and seller agree that I am paying you 50%, let's do the registry, I'll pay you the rest 50% 6 months down? Why do you say no?
Because if registry is done, the transfer of the property is
Yeah.
already done,
Yeah.
and he might disagree to pay the
Okay, fair point that he might disagree or he might default. So generally nobody does. But still a lot of deals practically happen, in which case, depending on your comfort, or for all you know, you might know a buyer, it might be a family member, it might be a friend. You say that, okay, you don't have any money, don't worry, let's do the registry. You start staying, if it's a flat or whatever you start using, you give me 6 months down the line. And now, as you are rightly saying, 6 months down the line, he doesn't pay. Either he doesn't have money or his intentions change to not pay you. What do you do as a seller?
We can go to the court, but this
And-
clause needs to be added into the agreement first.
Okay, it will in general be added. If you are agreeing for a payment after registration, it will in general be added in the agreement. Let's say it's in the agreement, still he doesn't pay. Then what do you do?
Then the only court option is
And then when do you get your money?
after a few years. Then
After few years. How many years can those be?
n number of years.
Okay, so can you define n or give me a range?
10 years, 15
Okay,
years.
10 years, 15 years. So you yourself have said. Now let's come to the equity market and bring this whole scenario to the equity market, secondary market, the trading on the stock exchanges, BSE and NSE. You need money, or if you don't need money, you think that you have a share which has given you good return, its valuation is to your comfort now not attractive, you want to sell, you want to book profit. What do? Somebody else? You come to stock exchange, of course you have to open an account with a broker. It's necessary to have you can access stock exchanges only through a broker who is a registered member of the stock exchange, and then you sell it. Yeah. And then what happens after that? Sorry? When does it come? Okay, and is it guaranteed that it will come?
Yes.
Can there be a default like we saw in real estate? No. Why? Exchange guarantee, which is what we call, but yes.
Margin is set.
Okay, so now we are getting more and more into technicals, which is okay, margins and all.
Because the account is debited at the same time once you buy, so the payment is gone from your account.
Okay, so here you are right. So if you are buying something, your account is in some cases it is debited. It doesn't happen in all the cases. Which are those cases? When you pledge your shares to the broker, he gives you margin, or you can also borrow margin by paying some interest, and all those combinations are there. So yes, you are right. In that case, it is settled. But we were talking of a seller. I sell a share, and is there a possibility that my buyer defaults, so I don't get money? Is there a possibility? No. Yeah. So that's a very clear difference, and that's why the importance of this whole infrastructure institutions, or the mechanism that is set in the capital market, is really important, that has come in. In fact, you are selling a share. Do you know your buyer who is buying? No. So if he were to default, would you be able to catch him anyway? You don't even know him. Yeah. So that's where the whole settlement that we are talking of comes in, that there is something called concept of novation. So which means your counterparty is not the person who is buying the shares that you are selling, or vice versa. If you are buying some shares, your counterparty is not the person who is selling you shares. Your counterparty is clearing corporation. Clearing corporation as an intermediary comes into place, and it guarantees all the trades. If there can be default. As I said, there are cases wherein I bought some shares and I'm not able to pay. My broker gave me a margin, or I pledged my own shares, but I did more trade and I'm not able to pay. So how to recover from that and all that is a process which will be taken care. But for the moment, in terms of exchange, or in terms of the person who has bought the shares, he will be credited with his shares, or the person who has sold will be given his money. These days we have T+1. So that's a settlement period. Next day you will get your money. So that's the kind of mechanism that is there. And that's, again, as we said, that when secondary market exists, we have a comfort while investing money in primary market, that I have a exit mechanism. My value might be lower or higher depending on company performance, market performance, and things like that, but I have a comfort that there is an exit. Same way here, when I again trade on the stock exchange, buy, sell, invest, I have a comfort that my trade will be guaranteed, will be honored. I don't have to worry about it. So that's the whole mechanism that has been created. Yeah. To provide market integrity by providing platform for disclosures. What is that? So any company which comes out with an IPO, what is happening is it's obviously getting multiple investors who are not promoters, isn't it, to invest in that company. Now, if you have invested in a company in an equity, you obviously want some information so that you can decide whether my share should go up, go down, and all that. So all those obligations which are specified by SEBI have to be informed to the stock exchanges. So listed companies have to give quarterly results, which have to be informed to the stock exchanges, who in turn make it public. Of course, companies also put it on their website. Then on a quarterly basis, they have to give the shareholder information, and if any change is there. Then on an ongoing basis, they have to give any important developments that might have happened. Key management personnel, CEO, CFO, MD, or somebody has resigned, or a new person has been appointed, and multiple other such things you have to disclose to the stock exchanges, so that the people who have invested in your share, which can be the retail, which can be institutions, which can be FIIs, banks, other corporates, or anybody, gets that information and can accordingly take a call whether they want to continue to hold your share in expectation of share price going up, or they want to exit. And of course, obviously, that information is also used by the other potential shareholders who are monitoring your company to buy. So they will also need some information if they want to. So there is an X amount of information you are given when you came out with primary issue, but on an ongoing issue, after which your share has moved up or moved down, for you to be able to evaluate, you will need information. So that's where stock exchanges also come into the play, that they are a platform for disclosures. To conduct surveillance, this is slightly technical, that whether the trading is happening properly or not, is somebody trying to corner the shares, is there insider trading happened, all those regulatory functions are monitored. And to regulate conduct governance of issuers by prescribing governance standards and enforcing the same. So largely related to information sharing, minority shareholder friendliness, and all those things that are there. Okay, depositories. So this is something that came in before. Earlier in India, we used to have physical shares, share certificate by paper. So if you are selling share, you will have to give that share certificate to the buyer, and there will be a transfer deed or transfer form, in simple words you can say, which is stapled at the back of the certificate, in which the seller will sign and give that, okay, I am selling, and the buyer will take it. He will send it to the company, the share will get transferred in his name, and company will send it to the buyer. And again, like that it used to keep going on. Of course, I am trying to put it very simply, but it was a very cumbersome and inefficient process, doing all these things and dealing with that. So to take care of that, depository came into the picture, wherein we went in for dematerialization. All the shares, the paper form of certificate was done away with, and the shares are now kept in the dematerialized form, and which is where depositories track all the actions related to the shares that are there. So to establish legal status for record keeping, because the depositories are now maintaining all the records about the company, to create a legitimate status and facilitate intra-depository transfer. So there are two depositories in India. Which are those? NSDL and CDSL. So you can have account in either any or both. There is no such restriction that you can have only one depository. Like broking account also, you can have multiple. Bank accounts, of course, you can have multiple. To enable pledging and incidental facilities. What is that?
If I find a proper share that in which I can invest and generate more return, but I don't have cash, so I will give my shares to the broker and will take money once, and that I will invest in that particular share. Once I generate returns, I will give money back to the broker with some interest and my return.
Yeah. So basically, what is happening is you need some collateral. There's a lot of gold financing which goes on in India. We have gold, we need money, we can go and mortgage it. There are a lot of gold loan companies, a lot of banks who do that. So the lender will not have to think about whether you will return money or not, whether your financials are strong or not. You are in urgent need of money, you give him gold. Gold is something which is internationally acceptable. He immediately gives you money. So the same facility has been extended to the shares also, that you can pledge your shares and borrow money against that to do whatever multiple things also. Of course, he gave stock market related example, which is where it is mainly used, but it can be used for pledging to other people also. So when you pledge, you have told now there is no physical certificate. So if there were physical certificate, you will give it to your lender, your bank who is giving you loan, that okay, keep my share certificate as a collateral. Now, as we said, with depository, there is no certificate. So what do you do? What does the lender do? He's giving you money, he wants your share certificate. He can't get share certificate because it doesn't exist. So what does he do? How does he get a guarantee that you have pledged your share to me? So that's, yes, sorry, go ahead. Yeah, so it's not exactly get transferred, but both the parties together make an application to the depository. The person who owns the shares will say that I am pledging my shares to this person because I am borrowing a loan. And the person who is giving you loan will say that pledge these in my name. He can't sell them till the time he repays my loan. So that's what depository do, that they mark a pledge, and those shares kind of become non-sellable. Still, if you sell those shares, then there is a mechanism in which you have kind of done short selling. You have sold some shares without actually having them, because the moment you sell the shares, they will come up for settlement, and then depository will check. Depository will say, but your shares are pledged, I can't transfer them out to the buyer. So you have to go and kind of buy those shares in the market, which is a complete proper mechanism. Of course, you end up making a lot of loss, because when you try to cover sold shares, your price you have to pay is much higher. So there is an auction and all those things are there. Yeah. and to enable and facilitate electronic settlement. So every time the settlement happens, they delete the name of the existing person who has sold the share and transfer the shares in the name of the buyer and put it in his demat account. Every demat account is an individual unique code that is there for your account. Other benefits: efficient accounting system for investors and brokers, help broker monitoring client behavior with respect to settlement. So again, they can track that are you a good customer, are you paying timely, are you defaulting, and things like that. Efficient delivery of shares on allotment in public issues. So another important point. What is this? Efficient delivery of shares on allotment in public issues. So just like when we buy in the secondary market, we are supposed to get shares, which we have said that are not in physical form anymore. But we get, let's say we have bought 100 shares of ABC company, it comes into our demat account and it clearly reflects that we own ABC company 100 shares. Same way, if we applied in the public issue of a company, and if you are lucky in these days, because there is a huge oversubscription that goes on, and you get shares allotted, then you of course get a mail and a SMS saying that shares have been allotted, and those shares get credited to your demat account with the depository. So that's what is the action that is done at a depository, that whenever there is an allotment in case of public issues, the shares get transferred into the respective account of the allottees. Unique identification of security. So every company that gets listed has a unique identification number that is there. It's easier to track and monitor with that. Clearing corporation, we already saw. I told you about the function of novation, that your counterparty is not the person with whom you are entering into a trade. Your counterparty is clearing corporation, who is kind of guaranteeing all the trades. If somebody is defaulting, there are mechanisms, processes how to settle with that person, but the person who has come and traded, who has bought and sold, immediately gets his trade honored. Whether if he's selling a share, then he gets his payment. In most of the cases, if he's buying a share, it gets credited to his account. Settlement guarantee function, netting function, all those things that we have talked about. Risk management function, okay, important point. So this is slightly technical. Maybe we'll come back if we have time. Basically, what we are saying is that with so much of trading happening, as I told you, NSE is the world's largest stock exchange. In terms of number of trades in derivatives, there are about 65 crore trades that happen on a daily basis. I mean, the range keeps moving up and down, 40-50 crore on some days, 70 crores on higher days. Again, if market sentiments change over a period of time, market sentiment improve, probably number of trades will go up. If market sentiment comes down, number of trades will go down. But that's the kind of volume that gets traded. As I said, 65 crore number of trades in derivatives. 5 crore number of trades roughly in cash market. We saw cash and derivative in terms of types of capital market. So that's so now with so many trades, regulators have to keep monitoring that is there a risk to the market? Is something wrong happening? Is there a situation wherein suddenly people won't be able to pay? And multiple things. In the past, when physical share certificate used to happen, there also used to be duplicate share certificate. So nobody will know, like you can have duplicate passing certificates these days, duplicate degree certificate, duplicate diploma certificate. You can't check. Of course, now blockchain based technologies and scan QR based all those checking systems are coming in place. But that is something that regulators, so stock exchanges are first level regulator. Of course, ultimate regulator is SEBI. But stock exchanges through the clearing corporations and depositories also have to keep looking at various indications which they do through the various advanced softwares that are available. They keep checking that any kind of risk that is happening because the trading has suddenly gone up. It could be either individual company based trading, or it could be overall market, how things are developing. Okay, so in terms of some numbers, before we go into more details, size of Indian market, Indian economy, as we said, ecosystem. So what is our ecosystem in terms of size or in terms of some numbers? So these are some numbers. You may not be able to read, so I'll read important ones for you. Okay. So these numbers are as on 30th June. Obviously, Nifty was 24,000, Sensex was close to 80,000. But what is important is last 1 year, Sensex went up 22% and Nifty moved up 25%. I'm sure all of us know with the way the equity market has been doing well, that's the kind of. And the same way in the last 3-year period, the Nifty went up 52% and Sensex went up 50%. Of course, small and mid cap have given much higher return. I have not put those numbers. Maybe if time is there, we'll talk about them. But Sensex and Nifty represent large cap shares. Yeah. How many companies is Nifty? 50 and Sensex? 30. In terms of interest rate in India, we are currently RBI's repo rate is 6.5%. Yeah. It was at 4% 3 years ago. Why was it at 4%? Any reason? Anybody recall what was the scenario at that point of time? COVID. Yes, you are right, sir. Yeah. So the whole world, including India, came in COVID. So to support the economic activities had practically got closed for some time, and then they slowly started to pick up, which obviously led to the economic slowdown. When there is an economic slowdown, the regulators as well as the government of the respective country want the economy to come up. If you want the economy to grow, you make the cost of money lower. You bring the interest rate down, so that if people have to borrow, they are able to borrow at a lower cost and able to spend or invest. And then obviously it's a complete cycle. What happens when you keep interest rate low at for a reasonable period of time? Cheap money is available, people keep borrowing, and as a result keep spending, keep buying, of course keep investing also. Then what happens as a result? Okay, so what does that multiplier effect does?
Like so our income would become some other's income and it will keep on multiplying like
Yeah.
this.
Yeah. So which is where the economy is growing, and that was the intention of the regulator, that because economy was in slowdown, they want to give a push to the economy to grow. So multiplier effect, economy has grown or has started to grow. But what happens after that? Increases the interest, the rates, the inflation. Basically, because money is available cheap, the demand for goods is growing more and more. The demand is growing more, sometimes supply is not able to keep pace with that much demand. So as per the common supply demand laws, obviously the prices of goods will start going up. That will lead to inflation. So then what does one will have to do?
Interest rate will become higher, like 6.5 or 4 to
Yeah. So will become higher is so just to clarify that, regulators will then start increasing the interest rate, will start making the money costly, so that your intention or the feeling that you meaning anybody was having that money is cheap, I can buy and spend or I can buy and invest, money becomes costly. The interest rate have been raised. So money becomes costly, suddenly the demand of the money comes down, and as a result demand for goods also comes down. And by then, because of the earlier period, suppliers had started to increase their capacity, so the supply goes up. But anyway, so the regulators raise interest rate, and that's where we are today. And now what is being planned, what is happening in the US, in India, or in other economies? So we have reached a period, so it's a cycle of economy which keeps going up and down. We have reached a period wherein everybody feels that inflation has been high for quite some time. It's time to bring it down. So what are the various central banks, Fed in the US or Reserve Bank in India is saying?
they have issued
Sorry,
Rate cuts.
are they cutting?
They are expected.
Yeah, so they are saying we are still monitoring the inflation rate. So while it has come down, it is tending to come down, but it is still not down to our comfort level. So they have not started cutting, but they have stopped hiking. So it's almost 2 years or so that RBI has not hiked. Same for Fed also, but they have not started cutting. Maybe there is an expectation that at least the US Fed should start cutting within this calendar year. RBI still might take some time, but that's a typical cycle that happens, and that's why in our ecosystem currently we are at a 6.5% interest rate compared to the 4% that was there. So 10-year GSEC, it refers to the government securities. When we earlier saw that who needs money, we all said government also needs money. So government borrows money in the market and that becomes a benchmark. So while RBI has a certain rate, obviously all other rates are higher than that. So government securities 10-year paper is currently trading in and around 7%. Currency GST collection, I am sure all of you know, is now at 1.74 trillion, 1.74 lakh crore, which was the June number. It was up 8% over the last year's June number. And of course, if you compare it to 3 years ago, it's up 88%. And then you have some export and import numbers also here. So that is an area which was kind of running weak. If you see the export for June 23, it was down 22% negative. Now, of course, it has become positive, but for the reasons of world economy kind of being in the slowdown, we were not able to export as much goods as we used to do, and that led to the negative export growth rate. So all these are part of our ecosystem wherein these are the activities that the macroeconomic data that on daily basis gets monitored, gets analyzed, is used to make predictions so that future planning can be done. And then we have the inflation numbers that we are talking of. There is CPI consumer level and there is wholesale level. So at consumer level, we have 4.75. Recently, the number has come is at 5.08 or 5.8, 5.08. Yeah. So it has again gone up. And that's why, as we said, that the central bank, the RBI, is still saying that. In fact, there was a statement of RBI governor hardly few days ago that right now we are still waiting and watching the inflation trend. So immediate interest rate cut is not on the cards. Okay, more important function, what is the market cap of Indian market? So here is the number. It's almost 450 lakh crore. Yeah, 450 trillion. Indian rupees, of course. Now, to put it in perspective, the number itself, unless we put it in perspective in terms of comparison with some other numbers, it may not give a sense. So to put some sense into it, what is our GDP?
How much goods have been produced within the economy?
Yeah, so that's a definition, goods and services and net of export, import and things like that. But in terms of rupees, if I were to tell you, India's,
3.9 trillion. Almost 4
yeah. So almost $4 trillion. Yeah. Convert it into Indian rupees, what it comes to? 300 trillion rupees. So for FY24, the nominal GDP of India in Indian rupees is 300 trillion, 300 lakh crore. Now market cap is how much? 450 lakh crore. So it's higher than GDP, lower than GDP. It's obviously higher. 450 is higher than the 300 and is almost 150% of the GDP. So India's market cap is 1.5 times of India's GDP. Now, to put it in perspective, when you compare it to the global standards, it is expensive. Globally, the market cap of various countries with respect to their GDP are around 100%. In most of the cases, it's lower, 70-80%. In some cases, it's even lower. In some cases, it's higher because now the globally the equity markets have been doing very well. But still, India's is reasonably high, quite high. So I don't have the ready exact data, but at 150% of GDP, the market cap would probably be the highest in terms of multiple of GDP in the world. And to that extent, Indian market, so we are talking of price discovery or valuation and all. So the valuation of Indian market to that extent compared to the other global markets. So we talked about FIIs earlier. All of you said who are the investors? FIIs. FIIs invest across the globe, across various continents and countries, depending on the comfort of their financial economy of those countries. So they see all these parameters that, okay, what is the valuation of Indonesia? What is the valuation of US? What is the valuation of Spain? What is the valuation of India? So Indian market is at 150% of its GDP. As I said, I don't have the ready data, but probably is highest in the world in terms of multiple of GDP. Now, you tell me. Okay, So his question is it good or bad that we are trading at 150% of GDP, which, as I said, is probably the highest in the world. So, as they say, the beauty lies in the eyes of the beholder. You see whether the glass is half empty or half full. So, if you are trading at 150% of GDP, which means that people were or are willing to invest for your market to have brought down to this level. Why would they do that? Is because they find your market as a good market, good in terms of financials or fundamentals. They think that money invested in this market will give me return. So that's one way to look at it, that probably it's good. It is bad in the sense that yes, at 150%, some comfort or caution will come into my mind that okay, market might be good, Indian economy's fundamentals might be good, but does it deserve it to be there? Are my chances of market falling more from here, or the chances of market continuing to go up from here are more? So it's both ways. Yes, your question.
Another question, just adding to that, it
Yeah.
becomes less attractive to investors sitting outside thinking that the return would be compared to other emerging markets would be less in India if it's trading at 150 or 200%.
Yeah, so you're right. So that's one way to look at it, that the more you keep becoming expensive compared to other global market, a global investor would possibly, for us also, even when we go into the market to do shopping also on Amazon, Flipkart and all, and right now we have a website which compares the prices of all the websites. So we obviously buy it cheapest. Now, when we do it for as small thing as, let's say, toothpaste or whatever, when you are investing your money, you obviously want to invest in the cheapest possible. But then also comes, you also look at the quality or the brand of the good that you are buying. You obviously compare it apple to apple and oranges to oranges. So when it comes to investing globally, then you start looking at, now again, partly to answer your question and to add to your point, we talked about India's GDP being $4 trillion, roughly 300 lakh crore. What is India's GDP's growth rate? 7%, yeah? Sorry? Yeah, so whether you take quarterly or you take annualized, 7.5% kind of thing, 8%. In fact, it was 8% recently. Now, where is it in terms of ranking globally? What do you mean 82? No, I am talking in terms of GDP growth rate only, no other factor. Yeah, highest. Yeah, you are number one growing country. Now, when you are number one growing country, what it means? That your economy is doing well, isn't it? Your fundamentals are reasonably good, maybe more than reasonably good. Now, if that is the case, then what global investors will do? Possibly invest more. We can't say for sure, but yes, they'll say that okay, the market is expensive, but if I want to invest in a highest growing economy of the world, I will probably not find it cheap.
So the difference between the market cap, that is a 50%, that 0.5% we have, is not a direct indicator of the market, like in a fundamental sense.
It's an, I don't know how to answer your question. It's an indication of multiple things. So at the outset we said that it is probably the highest in the world. As I said, I don't have the ready number, so I can't say, but most likely at 1.5 times of GDP, the market cap of India is probably highest in terms of multiple of GDP in any other country, number one. Number two, obviously when you want to draw inferences from that, your inferences will be that it is the highest, it's the most expensive market. Then you will extend the inferences further that okay, if it is the highest, there has to be some reason. Yeah, why is it trading highest? It's trading highest because its GDP is the fastest growing GDP in the world. And if it's the fastest growing GDP, then obviously other fundamentals, other numbers have to be in place. So that's how you draw inferences. But yes, you can't 100% draw the inferences, and that cannot be the only measure or only indicator for you to take investment decisions. So our class is not for investment decisions or analysis or research and all, because I can't talk about ecosystem unless I build your perspectives on these multiple things. So that's why I'm talking all these numbers. So this is nothing but ecosystem. Now, how to get into deeper and deeper into that ecosystem, into each of the points, you of course have sessions all through the week, and even those will not suffice for that matter. It's something that, depending on the work content, the role that you do or anybody else does, it's a multiple things that you will have to keep doing. In fact, let's take these numbers further in terms of more numbers. So what is India's mutual, and that is where partly your answer will come in. What is the India's mutual fund AUM and number of folios?
54 lakh.
Okay. Okay. Yeah. So that number keeps growing every month. So it's difficult to track. I think the recent number is 62 lakh crores, which is close to what you said. But yes. So that's the kind of investments that we have in our mutual fund in India today. And in terms of number of folios, it's 18 crore, roughly 18 or 18.2 crore or something. So very simply put, 18 crore are the investors in the mutual fund. Not exactly, because there are dual portfolios, multiple portfolios. Then some of these folios belong to non-individual investors, companies, corporates, and things like that. But okay. So that's an indication that we have 10 minutes left for our session. So any questions from whatever we did, because otherwise we'll run out of time, or you, of course, you can keep asking alongside also. So mutual fund, yes.
So in comparison to the capital market,
Yeah.
is GDP a little lagging indicator? What do you think?
No, why would you say that? So GDP is something that most of the countries monitor and calculate on a quarterly basis. So first of all, a provisional number comes in, and that number keeps getting finalized. If you build enough advanced systems, which because of the growth of technology over a period of time will come, you can probably move on to track it on a monthly basis. But it will always be a data with a lag. You can project GDP, either absolute number or the growth, but the exact number you will know only when the activities have happened, isn't it? That's what. Sorry?
The calculation of GDP is not standardized across nations. Like there are nuances.
Yeah.
Some
So a broader formula is a standard, but yes, countries use, some of them will classify a particular export or import in one category and things like that. But a broader formula for any economic student or an economic course is very well defined. So it will be a lagging indicator always. You will know the actual GDP only when activities in the economy have happened. Now, how do you read it is up to you ultimately. So this is one way of looking at it. Now, what are the number of demat accounts that we have in India? Is 16 crores. So we saw mutual fund folios are 18 crores and number of demat is 16 crores. What is the population of India? 140 crore. So what is this number?
But 10% of the total population.
10% of 140 will be 14 crores. So yeah, it's assuming unique and multiple and all, it's 10%. So of course, in 140 crore, children are included who are not eligible to invest or who don't have money. There are a lot of people who are much below poverty line. Unfortunately, they don't even have enough to eat. So we can't talk about they coming to investment or saving or even bank deposits. Leave aside risky investing of equity and all that. So to that extent, it's not. I mean, that's not 140 crore to this crore is not an exact comparison. But yes, even then, if we were to say, this is where the statistics are in terms of India. What is the size of bank deposits in India? So mutual fund, we saw 62 lakh crores. Bank deposits is about 200 lakh crores. Yeah. So let's say 66% of GDPs are bank deposits. Now, more importantly, so we can say mutual funds is roughly 1/4, 25%, 30% of bank deposits. This percentage number about 20 years ago used to be only 10%. So if assuming this bank deposits was same 200 lakh crore 20 years ago, the mutual funds was only 20 lakh crores. And this number has grown. In the developed market like US, it's the other way around. The mutual fund deposits or the mutual fund base is much higher than the bank deposit base. Because those are the markets which have developed, which have grown. There the investors have understood. They have become knowledgeable. They have been taught, they have themselves have learned. So for an individual investor's point of view, keeping money in a savings account, and you will find a lot of people who even today the salary comes, keep lying in savings account. Some of them at best will move it to FD. Yeah. So depending on, of course, you have to do full financial planning, asset allocation and things like that. So that's not the efficient way to save or to invest. Saving and investing are two different things. They are not same. Yeah. So that's where in India also we have mutual fund assets, which as a percentage of bank deposits are continuing to grow because people are becoming aware, becoming conscious. Daily traded volume cash in our markets. So as I told you, in terms of number of trades, derivative trades are roughly 65 crore on daily basis. Cash market trades are about 4 to 5 crores, and it keeps changing. In terms of number of trade value, if I tell you in derivatives and cash, derivative daily basis, the amount traded, notional amount in rupees, is 1 time of market cap. So if 450 lakh crore, which is our market cap, almost 450 lakh crore worth of derivatives get traded on a daily basis. And that's quite high. And that's why regulator is conscious, is kind of trying to see that whether it is sustainable. And as per SEBI's study, 90% of the people, especially retail investors, make losses in the derivative trades in futures and options trade. So that's where we saw the risk management capability, the assessment, the market, the stock exchanges, regulators, clearing corporations and all keep doing on a daily basis is very important. So that's the kind of trade which is there in derivatives. Of course, in cash market also it's high. So that's I think 1.5 lakh crore or some 150 lakh crore or something is the number that is there. But more serious is the derivative volume trade. Did you have a question? Of course, India's GDP, I've already told you, and I've put those things in perspective for you as an ecosystem. Where are we in terms of growth rate, in terms of the GDP itself, and in terms of market cap to GDP? So there are a lot more things. The observation that you had, that can it be an indicator, can it not be an indicator? There are multiple things that will go into trying to predict any particular, trying to analyze a particular ecosystem in terms of its growth rate, in terms of its stability. We have not even talked about various other multiple macroeconomic parameters like fiscal deficit, current account surplus, current account deficit, trade surplus, trade deficit, currency. So while I did show you the currency number, so we have a rupee which is at currently 83.4 odd. In last 1 year, it has largely remained range bound, hardly a movement on the negative side of 1.6. But over a 3-year period, our currency had dropped by 12%. So that's also the global investors will see that I invest in a particular market, in this case Indian market, I will make some return. But when I withdraw my money, I bring it back in dollar terms, how much I will get. In 3 years, he has already made 12% loss in dollar. So in 3 years, and we saw 3 years, equity market has given 50% return. So for an Indian investor in 3 years, he has earned 50. How much a global investor has earned? 38. Yeah, 50 minus 12. So that is something also that you'll have to keep in mind, that everything might be good, but net of currency, how much returns will I get? So there are all those kinds of things. Any questions? We are coming to the end of our session. So these are all the third eye that we talked of, intermediary. They are all various intermediaries of the overall ecosystem that we have. So we of course skipped few slides earlier, but there are merchant bankers, there are registrars and share transfer agents. When you deal with, to deal on a stock exchange, you have to go through a broker. For a depository, to get your account open, you have to go through a depository participant, which can be broker also. Then you have underwriters. Who are underwriters? Very quickly.
जो issue करते हैं shares को market में, like bank can become an underwriter जो
issue तो कंपनी करती है. Shares are issued by a company.
backend पे सारे help करेगी shares distribute.
No, that is registrar.
Indemnifiers.
Yeah, in a way indemnifier. So basically earlier it was compulsory. So whenever a company comes out with a public issue or even rights issue, also depends, they have an option. If company thinks that what happens if my issue is not successful, what happens if it bombs, I have prepared certain investment plan, I need money, otherwise my whole growth scenario will come crashing down. So what do? You are coming in with an IPO, but There is a possibility a corona might happen, a World Trade Tower might happen, suddenly markets may crash. There are event risks which we can't say, the black swan risks. So what does a company do? What do we do when, let's say, we travel foreign? Insurance. Why do we do that? Just as safety. So company goes and buys an insurance. Those insurers in this particular terms are called underwriters. They'll go and say, I am coming out with an 100 crore IPO. Will you underwrite it? Underwrite meaning, if my issue doesn't sail through to the extent it is short, will you give me the money? Underwriter will say yes. Why will he say yes? Yeah. So first of all, he gets a money. He gets a fees to underwrite your issue, which is payable to him even if your issue is successful. So if your issue is successful, he neatly gets 1% means 100 crore, 1 crore money is making. It can be more also. Two, of course, he will analyze your company's shares and the valuation. He might say that, okay, and he will analyze the ecosystem. Where is the economy? Where is the country? What is the valuation risk and all? And he might say that, okay, I agree. And in that fees that he charges, he will cover his risk. If he sees risky, he will say my fees will be 5%. If he thinks it's okay, he'll say 1%. These numbers are just an example. They are not hard and fast. And yes, you are having a question.
So in this case, ideally, underwriters should do a little marketing about the company in the public, right? So that
Possibly, so that they simply earn the fees and don't actually have to pay. But that's not what they generally do.
I'd say that that's more or less market manipulation.
No, there's difference between marketing and market manipulation. Manipulation is a big word. No, again, influence. Yeah, I mean, so, but that's not their business model. Neither do they have people, nor do they have systems, nor probably do they have a skill set to market an issue. The marketing of issue is done by lead managers largely, and of course the company itself. But that's what an underwriter is there. Earlier it used to be compulsory in Indian market long years ago. Nowadays it's not compulsory. It's an option to the company that if they want they can go and do underwriting. Then there are credit rating agencies, which is more specifically applicable to the bond issues. In between, we tested the concept of rating equity issues also, but that hasn't become successful or popular. So now we are not doing that. We meaning as India. Investment advisors, research analysts, we saw there all those things and many more. So I think I will stop there quickly if last one or two questions are there. This is a big subject. As I said, we have skipped few slides earlier also, and then there are few slides coming up more also. But I think largely I have covered, yes.
We talked about everything was positive on Indian aspect.
Okay.
There's a small doubt then why is rupee depreciating then? And
Okay.
what will it take to go on the appreciation side? If all these things are not working.
Okay, so now we are changing the topic of our class to macroeconomy, but very quickly I will address. So currency movement is a function of whether you are a net importer or an exporter. India is a net importer. So that's one part. In terms of trades also and in terms of money requirement also. So even today as a country as a whole, corporates and everybody to put together, we go and raise a lot of money abroad in equity and in fixed income side also. So that's one reason. Two, obviously somewhere the government and central bank directly, indirectly, officially, unofficially come together and keep the currency rate in such a way that our exports are competitive. So if the currency will keep appreciating too much, our exporter will become relatively uncompetitive against the other countries. So that's where also the rupee in our case or currency of any country, these will be the reasons for the actual valuation of the currency as well as the intended valuation that government or the central banker might want to keep. Yeah. Okay, thank you very much. You will have a lot more sessions on all these topics individually and you will be able to get much more perspective. Yeah, thank you.